This morning to listen to our thoughts about the Tax Cuts and Jobs Act of 2017. We haven't come up with a good acronym yet, although there are a few names that the Tax Act's been called since the 22nd of December. It's a complicated series of provisions. It's 1,000 pages, and we're going to go over each and every page this morning. What are we going to focus on today? We're really going to focus on how the Tax Cut Act affects individuals and business owners, and being primarily our several of our practice group focuses. And the idea is going to be, and our plan is to start off with a brief discussion of the Tax Act and really what to anticipate going forward. And my colleague and partner, Sam Olchek, who chairs our tax policy group here in D.C., will talk about that and also talk about, in other words, we'll talk about what happened to crib a title of a book of a former presidential candidate. And then what to anticipate. And then after Sam talks about that, my partner, Gene Newland, please ignore the name card, we'll talk about the estate and gift tax and provide some planning ideas about what changes were made as a result of the act to the estate and gift tax. And then after Gene speaks, my partner from the Baltimore office and co-chair of our taxable planning group, Brian O'Connor, will focus on the business provisions, particularly the pass-through provisions, because so many of our clients are either S-corps or LLCs, and what the Tax Act looks like for them going forward. And Carol, my colleague at the very end of the dais, will talk about the employee benefits provisions of the Tax Act. I will wrap up with a few tidbits on some of the miscellaneous changes that affect individuals, very briefly on those. And then we'd like at the end of that series of discussions to talk about, or each of us will identify one takeaway for each of you to perhaps bring to your clients. And for your own practice, of course, as a result of the Tax Act. So that's it. Without any further comment from me, because we're in a tight schedule, and we want to get everyone out as proposed at 9:45. So without any further comment from me, Sam Olchek.
Thank you, Chris. Good morning, everyone. It's rather remarkable that we're here today talking about landmark tax reform legislation when the legislation repealed a total of one deduction, the Section 199 manufacturing deduction, and replaced it with the 199 Cap A, the 20% deduction for pass-throughs, and it repealed a total of 0 credits. But we are here. You're going to hear plenty from the subject matter experts here on the panel. I will say that this legislation will fundamentally alter individual and business planning decisions for the foreseeable future. As Chris said, what I'm going to talk very briefly is a little bit about what happened and a bit more on what to expect. So let's start with what happened. To me, this chart is interesting because it tells what to expect. The first markup in the Ways and Means occurred on November the 6th, Monday, November the 6th. That's when the markup started. The bill was signed into law by the President on December 22nd, a total of 46 days. To give you some context, the first significant markup of the Tax Reform Act of '86 occurred on October 15th of 1985, and it was signed into law a year later. So this bill was done in 46 days. The Tax Reform Act was done in 372 days. And I would argue that this bill fundamentally had more offered more changes, particularly with respect to the pass-throughs and with respect to the international provisions. What does that mean? That means that it means two things. First of all, there is a tremendous need for guidance and for clarification. And the second is that there were mistakes were made. So first I'm going to talk about the guidance. The guidance that we have seen thus far mirrors the urgency of the issues. So, for example, what we saw right away was guidance regarding withholding. We already have new withholding tables. Obviously, that is something that employers needed right away. We've also seen a fair amount of guidance in the 965 repatriation tax. Companies, multinationals need that information because if they elect to pay the tax over 8 installments, the first installment is due on April 15th. We've also seen the SEC issue guidance as to how to take into account the income tax effects for Q4 and for reporting purposes. FASB had to issue guidance, and it is fair to say that there is much more to come. So I mentioned that there were some mistakes were made. So for those of you who followed the process very closely, Chris alluded to the fact that the bill is called the Tax Cuts and Jobs Act. That was the name of the bill until the Senate parliamentarian, shortly before the last vote, concluded that having a short title violated the Byrd Rule. So the short title was struck. And if you look at the bill, this is the bill that was the legislation that was signed into law, you will see no reference to the Tax Cut and Jobs Act as a short title. However, given that this was done literally right before the last vote, the drafters didn't have a chance to go through the bill and remove all the references to the Tax Cuts and Jobs Act. So there are 9 provisions in the bill that refer to the Tax Cuts and Jobs Act, and where no such bill exists. So there are 9. That's a clerical mistake. That's something that could be done rather quickly and painlessly. That's one end of the spectrum. The other end of the spectrum are the significant changes that I know my clients are already dealing with, and I'll just mention a couple. The first one has to do with net operating losses. So for companies that have not net operating losses that are being carried forward to 2018, the intent of the legislation was to limit those losses to 80% of taxable income beginning in 2018. But that's not how the statute was drafted. Instead, the NOL limitation applies to NOLs arising in taxable years beginning after December 31, 2017. That means for a company that has, let's say, $1 billion of NOL carry-forwards, which is not uncommon since many companies are still carrying NOLs forward from 2008 and 2009, that's a $200 million NOL difference, and that's at a 21% rate. That's $42 million, and in my business, that's real money. So companies are already trying to figure out how to deal with issues like that. The second one, for those of you in this room that deal with real estate, qualified improvement property. Congress clearly intended to provide a 15-year recovery period for qualified improvement property beginning in 2018. The problem is that they forgot to add in 168E3 in the definition of 15-year property a reference to qualified improvement property. So right now, qualified improvement property does not have a recovery period. So that gives you a sense of very significant issues that Congress has to deal with. How do they deal with that? Well, typically there would be a technical corrections bill. However, over the years, the technical corrections process has become more controversial. For those of you that work in the Affordable Care Act, the ACA area, you will know that we are still waiting for a technical corrections bill to the ACA. It has now become a partisan issue, and technical corrections has, and it'll be far more difficult to get a technical corrections bill done. There's also other tax vehicles that could be used, perhaps tax extenders. The third one, the Joint Committee Blue Book. My staff friends remind me that if you go back to 1986, the 86 Act was passed in October of 86, and the Blue Book didn't come out until May of 87. So there was a period there of a good 7 or 8 months while the Blue Book comes to being. Other approaches. I think we're going to see this. I know that it was the experience when I was on the Hill years ago, where the two chairmen of the tax writing committees get together and say, well, we're going to, we need to encourage Treasury and IRS to issue some guidance. So we are going to write a joint letter to Treasury Secretary Mnuchin and ask him and encourage him to interpret the law in a manner that's consistent with the legislative intent. We can also see guidance from the IRS, and we've already seen some. But they are dealing with issues of limited resources. They've just requested, I think it was $450 million of additional funding to deal with the new legislation. We have a difficult political environment, and we are still waiting for a permanent IRS commissioner. Very quickly to stay on time here, what I just discussed, those were just the tax policy issues. We have the bigger issues of how whether this government will remain open come February 8th. We have the debt ceiling that the Congressional Budget Office said that this government is going to run out of money in the first half of March. And we are already seeing the effects of the 2018 elections. So stay tuned. I expect for those of you that are waiting for guidance, I would focus on the IRS. I think that's where we're going to see in terms of notices, news releases, information along those lines. And we will probably see at least one letter from the two chairmen of the tax writing committees encouraging Treasury to follow the intent of the legislation. And with that, I'll turn it.
How would they describe the intent? I mean, we don't have really committee reports, do we?
Well, the conference agreement does. It is clear, for example, in the qualified improvement property, it says the conferees agree that that there should be 15-year recovery period. So there is some legislative history that the two chairmen can point to.
And what can we advise our clients to do? I mean, should they hire you to go to the Hill and propose?
Well, that's always sound advice. But, it is important for you to for companies, for businesses to work through the provisions with their advisors and identify those problem areas, and then figure out a strategy.
Good. Great.
Sam, what are people going to do about the NOL issue that you raised?
That's a tough one because I've already had to deal with that on earnings calls, and they're not sure.
Yeah, how do you deal with the financials?
They have. I have encouraged them to take the conservative approach and say that this is what Congress intended, but the problem is if there is not legislation in the foreseeable future, then taking a position that is entirely inconsistent with the language is awkward. So that's
one of the things I think we've seen with prior tax bills is that even after the bill is passed, that there is a certain amount of flexibility to go to Congress and try to get things into the Blue Book. Do you see that happening this time?
Absolutely. In fact, I think that's why I wouldn't be surprised if the Blue Book is viewed as perhaps it is post-legislative history. It's not contemporaneous, but a lot of emphasis will be placed on the Blue Book, and I suspect that the Joint Committee will perhaps slow down the Blue Book process to take into account to receive all the comments. So there's going to be a lot of emphasis on Blue Book this year.
Brian, to answer your point, you've seen some of those adjustments in the banking industry, haven't you, in terms of tax losses and how they're treating this? Good. Thank you very much, Sam. Gene, you're going to talk about estate and gift tax changes and some planning ideas as a result of those.
Right. Well, you messed my lead up here, which I was just going to say. There's one estate tax change in the bill. The exemption went up, right? No, I'm just kidding. So, in any event, that's the biggest portion of the bill from an estate tax perspective, and really the only portion of the bill in and of itself that essentially doubled what the exemption is based on what last year's numbers were. So, from the chart, you can see where we started in 2011. And moved up from there. Many people remember 2012 and the rush to do a lot of planning because all of a sudden it was going to all sunset and change. And then on January 2nd of 2013, lo and behold, everything got extended and we all about cried from all the sweat and tears that we put in at the end of the year. So one of the important parts of this bill is that this 11 million, which we're calling 180,000. So just going back to Sam's point, there's still guidance that needs to be issued. We were assuming it would be 11 million too, because earlier in 2017, they had said next year's exemption will be $5.6 million. So we all assumed it would be double because that was sort of the intent of what this legislation was doing. But that's not exactly true because the way they changed how the increases each year are calculated changes how this one is calculated. So they're using a chain CPI instead of an inflation adjustment. So we're still not 100% certain that it's 11,180, but I've seen multiple people calculate this based on the chain CPI, all of whom are clearly very into numbers, and they've all come up with this number. So we'll see if that's what it is, but it's a $20,000 difference, but maybe it's different. But that's one important thing. The number will theoretically, technically increase going forward. But the important part of this bill is what does it do for us? Uncertainty, once again. Everything under this bill sunsets at the end of 2025. So unless Congress does something before that point, in 2026, we go back to the 2011 rule. People are thinking it's probably going to be in the 6.1-ish, 6.2 million based on the old rules of what it would be in 2026. But again, that's all up in the air of what will happen. So the other thing that leads to is, well, what happens if, somebody says, wow, look at all this other exemption I've got. I'm going to make a bunch of gifts and I'm going to use it all up. One of the other pieces of the bill that is a bit unclear is what happens if you die in 2026 or thereafter where you don't have this exemption anymore, but you've used it. Is there what we call a clawback? In other words, where you pay estate tax on the gift that you made in 2018, 19, 20, whatever year you made it. Our understanding is the intent is that there is not supposed to be a clawback. But going back to the whole point here that Sam has made, it's not really written down yet what the legislative intent is. But what I've heard from people, and many of you in the room might have gone to Heckerling last week, my understanding is that there's pretty much a consensus that there should not be a clawback. And there's an understanding that Treasury has been asked to put out some regulations because what the actual legislative wording says is that here's some verbiage about what you do, but we're not going to really tell you what to do. Treasury is going to tell you what to do. So now it's up to Treasury to come out with some kind of regulation to say there is no clawback. There is a clawback in this circumstance. And fortunately, hopefully, crossing fingers, they're not going to wait till 2025 because obviously there's really no reason to issue any regulations but for our sanity anytime soon because it's irrelevant until it is relevant. So if they extended the law, if Congress changes and the White House changes, all this could go away and it could become even sooner an issue for those who are gifting. I mean, I have a client right now who is really raring to go. He's one of these people who, once you tell him he can do something, he wants it done. He doesn't want to think about it, and he wants to move on. And we've had multiple conversations about clawback. We've had multiple conversations about the generation skipping, using that, not using that, what that means. So it's, it's good. It's great that he is on it. But, it always makes us a little nervous from a planning perspective when we don't have all of the guidance that we would like to have. But in reality, we do think that, for the most part, even if there is a clawback, if there's going to be any appreciation on the assets that you've gifted, the clawback would only be on the gift portion, not on the appreciation. So you're probably still better off making the gift. So just one thought on sort of that clawback issue.
Now, Gene, aren't we going to be sitting here in December of 2025 wondering what's going to happen?
Of course.
Yes.
Well, I don't know about that. I think it all depends on, it might be 2020.
That's
it might
right.
be 2021. You never know, and that's the thing. I think more like 2021, because 2020, you know, even if there's a change in the election,
Won't go back
it'll
to-
take a little while to get the legislation in place and
Right.
get all the votes in place. But it could be anytime soon. And I have to say, I think I'll retire because I don't want I can't do another 2.
Another 2012. Gene,
Really?
you talked about GST. What are you thinking about?
So in this particular client's context, so the GST exemption, you know, also went up. It all matches across the board. The difference in the GST exemption, if you remember from the law that came into effect in 11, a state exemption is portable. So you use it, you don't lose. If you don't use it, you don't lose it. It can go to a surviving spouse. GST exemption is not portable. And is under the same rules. It would go away if there is, you know, a drop in the rate. So one of the questions with this particular client is he really wants to benefit his children today. He has no grandchildren. He's just very focused on his kids. So he wants to do 50% to where the kids are going to get it, 50% where it's going to go into more of a dynasty for the future generations. So the big discussion has been, well, what if you do that? And what if the law is going to go away? And now the GST tax is going to go away. Do you make a gift and pay gift tax? Do you not make a gift and just let it go away? Obviously, that pains us to say, just let it go away. No, no, no. You know, so of course, if he dies in the next few years, this is irrelevant. So it'll be used, it'll be fine. Everything is done for. But obviously, we are not advising our clients to die before the sunset. That would not be very ethical or nice, I think.
That was a 2010 argument.
Yeah.
I guess one of the things I was thinking is that if you had a trust that didn't have a zero inclusion rate, right? In other words, wasn't GST exempt, you might do a late GST allocation to that trust to make it fully GST.
Exactly. So there's a lot of things you can do, you know, if the client isn't looking to gift necessarily or used it all but wasn't able to use the exemption, like in our situation where this client doesn't necessarily want to use the gifting to benefit future generations that he doesn't know yet and really wants his kids to have a really good start in life. A really good start in life, it's based on what they've got already. But this is, I agree, that's a great way to use it and think about where there might be places that trusts that maybe didn't get allocations, things have changed in a way, you know, that you think really are going to benefit the grandchildren more, the kids have enough. So a lot of things to think about, in the trust, and a lot of other things we can think about, decanting, some other things that would take advantage of the GST exemption as well.
So you might look at an existing trust that's not completely GST exempt. If you've made the conclusion that that trust, which was initially intended primarily for children, really at this point should be used for grandchildren, you might do a late allocation.
Exactly, and possibly a decanting if you have ages of withdrawal or distribution that you might be able to somewhat push out a bit so that it does bypass the kids in a way too.
Right.
So if you need to, depending on the
Sam, let me ask you something that's triggered by the chain CPI that Gene mentioned. I seem to recall you talked about what that was scored as, that adjustment on the chain CPI. Do you want to maybe take a minute to talk about what the chain CPI is and then what the scoring might have been?
No, I could talk about that in 10 seconds because I don't understand it. But I will. It does have the effect of lowering the inflation adjustments, and the code is so inflation adjustment. You think about it in terms of rates, all the deductions, exemptions, or what used to be exemptions. Those are all adjusted for inflation. So anything that reduces the inflation factor will result in more tax being paid. And the estimate, the amount that was the estimate for that provision was north of $100 billion. It was between $100 and $150 billion. It was one of the more significant revenue raisers in the package, and it received virtually no attention.
That's over the 10-year period?
Correct.
Yeah. And that takes into account presumably Social Security, the increase in Social Security. Does the chain CPI apply to that? Do you know?
I'm not sure if it's the tax. I'm not sure if it's the one that I don't know the answer. I'm not sure.
That's remarkable. Sorry. Thanks. Gene.
Yeah, no problem. So one other important point to go back to, though, is we live in an area where there is state estate tax. So some states don't have estate tax like Virginia, but Maryland and DC do have an estate tax. So we talk about, we have these like big exemptions now, and you'll see on a future slide what we now consider moderate estates, in quotation marks, are like $10 to $25 million, which is a little scary to think that that's a moderate estate under the current sort of rules that we're in. So you might say, well, you know, a moderate estate, someone who is under $10 million or someone who is under $15 million, they don't have anything to worry about. Not necessarily true. So Maryland, for example, had enacted a bill a few years ago that was increasing the exemption over a certain period of time so that next year the exemption would equal the federal, and there would be portability. So great. So if you're under the federal, you'd be under the Maryland. Fantastic. Well, just a few days ago, Maryland introduced a bill to cap their exemption at $5 million starting next year. Now, one of the things I noticed in the bill is it also appears to eliminate portability. I did ask some people about that, and Section Counsel has gone to the drafters of the bill and said, was this what you intended? And they said, no, our intent is to keep with the spirit of what this was about. So they're trying to figure out a way, apparently, to fix that without redrafting an entire new regime of portability. So they're trying to do something to match it to the federal without matching it to the actual number in the federal exemption. So we'll see where that goes. That's something to watch out for. But that means now we've got to think about Maryland estate tax. Maryland estate tax is obviously at a lot lower rate. Federal estate tax is at 40%. Maryland estate tax, the top rate is 16%. So it is a lot less, but it's still money. And it's still money people don't like to part with. So we still have to think about our planning for the state estate tax. And we'll talk about that in a minute. And just want to focus on D.C. D.C. is supposed to go this year to the federal exemption. So query again, did DC intend to have an $11 million per person exemption? Probably not. So that is something, my understanding is that they're sort of thinking about looking at. DC, you may remember if you have looked at any of it, was based on budgetary sort of targets. And the targets were hit. Everything was passed in the fall. But again, that was before this legislation came about. So question whether, because it's $11 million over $11 million, does it still meet the budget? Do they need to go back and do something about that so that we're on a sort of wait and see approach with how DC is going to react? The other part of DC is DC did not include portability, so DC is a use it or lose it state. Again, there's no gift tax in both of these jurisdictions, so you don't use it up in making gifts. So that means if you die and everything goes to your spouse, you've lost the DC exemption, which could be as much as $11 million. It could be $5 million. It could be whatever, but just something to consider in the planning as well for clients.
Going back to this proposed legislation that was introduced in Annapolis, there were two bills really introduced, at least two, in connection or as a result of the Jobs Act. One was no longer matching the federal estate tax exemption. And the other was a tax relief to Maryland citizens to take into account the loss of the state and local tax deduction. And so you've got these two bills that are being introduced. And this is just our understanding, and it's based on just what we know is going on in Annapolis, is that the governor really obviously both those impact the fisc, the Maryland fisc, and the governor is willing to allow the reduction in the Maryland exemption in exchange for the tax relief for the loss of the SALT deduction. To put it a different way, you're likely not to see an increase in the Maryland exemption to the federal exemption in Maryland, because that's the concession that the governor will make in order to get the tax relief through.
So let's talk about our three sort of sets of clients and people and where they are. So we've got the clients who will never pay a state tax, regardless of whether the exemption is $11 million or $5 million or whatever that number may be. And we're not going to look at that literally whatever, because we know that the Democrats had pushed for $3.5 million. Let's look at it as if it sunsets or as if we are where we are today. So in that situation, one of the big focal points is going to be income tax planning and basis planning. Again, we don't want to kill our clients like now. That's not the goal, is to kill them off while there's a high exemption. But we start to have to look at things about whether to keep assets in the estate for purposes of a step up. So when we're gifting, for example, we often want to look at highly appreciated assets for gifting purposes because the person receiving the asset will receive the carryover basis and not a step up in basis. So if we're giving away low basis assets today, that may not be the best thing to do, even if they are going to be highly appreciating assets in the future, just because of the fact that we might want to hold on to those for certain clients to get that step up in basis. Obviously, there's a lot of considerations there. We don't know when anybody is going to pass away, but perhaps if we're looking at someone who is much older, it might be worthwhile to think about giving away the higher appreciating assets for purposes of using this or not. But in any event, for persons who are under the exemption amounts, it really does become important for purposes of gifting or for your passing away what's in the estate. So I know a lot of people have talked about, what if you've set up a trust a long time ago that says, you know, that had discretionary distributions, it has a lot of appreciation in it. What should you do with that trust for this beneficiary now? Let's again assume the beneficiary has no problems. You know, they're not getting divorced, they don't have asset, you know, protection issues, you know, they're everything's good in their world. So what do you do at that point? Do you make a distribution out of the trust? Do you not? That's something you have to consider now under this current rule. It may be a good time to make distributions. It may not be a good time to make distributions. So something else to think about with respect to existing trusts. With the planning, again, going back, we may want still to deal with formulas in their estate planning documents. Dealing with Maryland, for example, has a state-only Q-tip election. So if you're at a disconnect between the Maryland estate tax exemption, federal estate tax exemption, may want to use it. So we're still looking at trust planning. We're still looking at dealing with sort of the formulas that are going on, because again, we don't know what's going to happen. So we don't know if this is all going to be around. We want to keep flexibility in the documents.
How do you, this is kind of a geeky tax and trust and estates question, but go ahead. That's what I am, a geeky trust and estates lawyer. If you have a trust that's a HEMS standard, health, education, maintenance, and support standard, and it's sitting on $5 million, how do you get around that in order to distribute the assets out to the beneficiary?
You go to South Dakota. No, I'm
All right.
and to Canton.
Okay. All right. Well, that's an option.
That's one option. I think it really depends. I mean, I think you can get it out, but it's going to depend on the trustee and how comfortable they are with making that distribution and considering this sort of within the maintenance and support for purposes of getting the step up in basis. So it is, you know, that is a fairly flexible standard. It isn't 100% flexible, but it does have some flexibility, and maybe, you know, there can become a comfort level that would fit into that distribution standard, just because the step up in basis really does make a big difference. And again, considering, you know, that this person does not have, they're not just going to go spend it all, or it's all going to be taken by a creditor or in a divorce or something like that. It's always going to be the consideration, whether it's a fully discretionary trust or a HEM standard trust.
One of the things you've got to be careful about, though, is that unless you're able to get an independent trustee that's not subject to that standard, if you try to make a distribution under a HEM standard to a beneficiary, and most trustees would want to get the consent of all the beneficiaries to that distribution. So you have a trust that's set up for Generation 2, and there are Generation 3 people around. And you've concluded that it's a good idea to distribute the asset out of the trust to the Generation 2 persons because they don't have a taxable estate, and they'll get a new basis on those assets when Generation 2 dies. The trustee's usually going to want to get the Generation 3 consent. The thing you've got to be really careful about is the consent by the Generation 3 beneficiary a taxable gift by the Generation 3 beneficiary to the Generation 2 beneficiary? By consenting to the distribution, have they made a taxable gift? Right. So come consult with us before you do that.
So moving on to our moderate estates, these are the people who are likely to have estate tax should the rules sunset or go back for other reasons. What do we do with those people? Clearly, again, flexibility is extraordinarily important. Definitely thinking hard about making those distributions out of trust for step-up purposes because, again, we have no crystal ball. We don't know when they're going to pass away. And if they don't pass away when they have the higher exemption, you might have pushed assets into their estate taxing them at 40% instead of just on the appreciation at the capital gains rates. So something to think about there, but flexibility is certainly very important. And some of these people may not want to gift as much just because you are in a position where it's, a little questionable. So gifts become important of how you can do the most bang for your buck, but also maybe doing the least, if you want to call it harm, I don't want to say that, but taking less away. So we mentioned in here, grats, coupons are sort of good, but sometimes not good depending on interest rates, but grats in a way that they can get an income stream back. But still give away assets at a leveraged ability so that there is some gifting if there's a concern about, how much they're going to have, how much they're going to give away, and if this is going to go away. Very important, a lot of thinking. But a lot of the planning is still very similar, just kind of looking at numbers at a different level. And then finally, for our super, people who are above the moderate estates and are going to have estate tax regardless of whether there is a $22 million exemption, a $30 million exemption, or a $10 million exemption. Here we've got the issue of gifting, and just as I go back to the client that I mentioned at the beginning, should he be gifting everything today? Should he wait a little while so we have guidance on the clawback? In reality, probably should gift it and move forward and figure out, ways to do that. The last item in here, I'm not going to go into detail, but it is something that a lot of clients, or there's been a lot of talk about, I should say. One person in particular, Lester Law, wrote an article about it, which you can look for, and has done a lot of speaking on it. Many of you may have seen him talk about this.
A great name for a lawyer. Right?
Yeah, exactly. And essentially the idea is trying to, where you have a very wealthy child, successful child in the family who has gotten extraordinarily wealthy. Parents are pretty moderate, they've been just their middle-class family and their kid did really well. So they have this gigantic exemption. What do you do? What can you do to try to help use that? So the idea is trying to push assets to the parents in a way that doesn't use up your own exemption, because obviously what's the point? Push it to the parents, then they use their exemption. Well, that's a waste. So, but pushing it to the parents in a way through sales and small gifts and things like that, where they get a general power of appointment over trust property and can use their exemption, move assets to other children or grandchildren utilizing their exemption. Now, again, this one becomes a little bit interesting. There's a lot of, there's a lot of nuances to it. And again, this is not something that I've spoken on, something I've read about certainly, but there's nuances. And of course, you've got the issue of, well, what's that number? Is it a formula number because of these potential changes? How do you deal with that? So that's something, but something that we do have to, kind of think about in this world as to other ways to try to get more to the next generation without the estate tax.
Thank you, Gene. Brian, talk to us about the corporate and pass-through tax changes.
Sure. Let me see if I can make sure I can use the clicker.
Bottom one.
Bottom. All right. Enough of all this estate and gift stuff, right? Let's talk about the real big news in the bill, which for folks on the business side is going to be the changes in the rates for businesses, particularly the drop in the corporate rate to 21% from a top rate of 35%. Also, there's been a repeal of the corporate AMT, and we still have the ability for corporations to deduct state and local taxes. So pretty big things on the corporate side that should hopefully put our corporate rates more in line with what we're seeing in other parts of the world and increase competitiveness for U.S. corporations. Now, does this mean that everybody's going to pile into C corporations? The answer is probably no, because we also have more big news, and there's a deduction available now to individuals, trusts, and estates for qualified business income. They can take a deduction up to 20% of qualified business income, and this deduction, if it's not subject to any limitation, effectively is going to reduce the individual rate down to 29.6 on this type of income. Now, that's a 10-point drop from the 39.6 rate that was in place in 2017. So pretty big news on the pass-through side, which we expect is going to keep most people that are in flow-through status, continuing in flow-through status. They're not all going to pile into C corporations, although there may be cases where it makes sense to move to a C corporation. We'll touch on that in a little bit. More on the pass-through deduction. It's going to be what is qualified business income. We can take up to 20% as a deduction of this amount. It's generally going to be your income and gain or deduction or loss from a qualified trade or business. And what's a qualified trade or business? That's going to be pretty much any business other than a specified service business or a business of performing services as an employee. And a specified service business, unfortunately, is going to capture all the folks on this panel, probably a number of folks in the audience, is that it's a service business that's in the traditional forms of health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, all the types of things that you might expect would be excluded. Now, other things that are excluded is if you have wages or guaranteed payments or investment type income, that's not going to be treated as qualified business income. That is subject to this availability of the deduction. How do we calculate this? First, we look to the lesser of 20% of our qualified business income, and we compare that to the greater of 50% of W-2 wages with respect to the business, or 25% of W-2 wages plus 2.5% of unadjusted basis of qualified property. We get that number, and then we add to it 20% of our REIT dividends and our allocations from publicly traded partnerships, and there we're talking about ordinary income allocations from publicly traded partnerships as opposed to capital gain allocations. So effectively, there's this cap that applies dependent upon your degree of W-2 wages, which of course is going to make the calculation of W-2 wages very important in determining the impact of this deduction. Let's talk more about the limits. If you have income below certain thresholds, even if you're involved in a specified service, you can get the full benefit of the 20% deduction. So if we look at the chart to the left, we have someone who is at or below the thresholds, which for single taxpayers is $157,500, and for joint taxpayers is $315,000. Regardless of whether you're in a specified service or a non-specified service, you'll get the full benefit of the deduction without having to worry about the W-2 limit. There's a middle ground within which you phase out, but once you get up to the complete phase out, which is $207,501 for single taxpayers and $415,000 for joint taxpayers. If you're in the specified service, you do not get any deduction at all. If you're not in the specified service, you can get the full benefit of the deduction, but you're subject to the W-2 basis wage limits that we talked about. Let's go through an example, show how this all works. If I have a wholly owned business that purchases an office building for $6 million, and I go ahead and allocate $3 million of that purchase price to the building and the other $3 million to the land, and I generate rental income of $500,000, my maximum potential deduction is going to be 20% of my rental income, or $100,000. If I paid no wages at all, I'd have to look to the second part of the wage limitation, which is 25% of my W-2 wages. Here, that's going to be zero, plus 2.5% of my qualified property, and 2.5% of the $3 million. I wouldn't be able to take it on the land. I'd have to look only to the depreciable building. Is going to give me a cap on the deduction of $75,000. If I were able to allocate $4 million as opposed to $3 million to the building, in this case, the 2.5% of qualified property is going to give me the full benefit of the deduction. So this example illustrates a couple of important points. One, it shows how it's always better to allocate as much to building as opposed to land as you can, but we already knew that. The other thing is it shows that even if you don't have any W-2 wages, you can still get the benefit of this deduction. And that, of course, is going to be particularly important for rental real estate, where there's often not very much in the way of W-2 wages. So a lot of our clients are going to be able to benefit from this deduction, regardless of their form. So what don't we know? What's open? And the answer is quite a bit. There's a lot that we don't know. There's a lot of questions with this provision. We're going to have to wait for guidance to really figure out much of what we do need to know. One is we're talking about a qualified trader business. We're not always going to be certain whether or not we have that. For example, if we have a net leasing of real estate, there's plenty of authority that tells us that that might not be viewed as a trader business. So presumably it's going to be outside of the qualified trader business definition. We'll have to see how that plays out. If I've got multiple projects that are under common control, we don't have guidance as to whether or not we would group those together for determining the effect of the deduction. We'll have to see how that turns out. And also with the specified service business, one of the categories of tainted businesses are businesses where the principal asset is the reputation or skill of one of the employees. We're not exactly sure how far that reaches, what that is going to address. We'll have to see how that plays out. Also, people have talked about, does it make sense to spin off perhaps parts of your business that are not going to be specified if you're in a specified trader business? So if you're in a law firm and you have an IT department or some other part of the law firm that is mixed in with the legal business, does it make sense to separate that out, perhaps have that held by a sister type entity and take the position that you can get the deduction on the income attributable to that piece because it wouldn't be a specified service when viewed in isolation? So we have that issue. I don't know how many people will go ahead and do that. I don't expect that we're going to do that here at Venable, but it might be something that smaller firms think about, smaller companies look into. Some companies might have a management company where they have most of their W-2 taxpayers or service providers housed. And if you had all your W-2 service providers in a management company, a sister company, and you had other businesses that were owned by similarly situated people, there's a question as whether or not you could count the W-2 from the management company over on the other side in the sister entity context. We'll have to see how guidance turns out for that. And a big difference between S corporations and partnerships, because an S corporation that pays W-2 salary to its owners would be able to presumably look to the W-2 salary paid to the owners in determining the amount of the deduction. But if you had a partnership that paid guaranteed payments to its owners, it's fairly clear that you wouldn't be able to look to the guaranteed payments as W-2 payments in determining the amount of the deduction. So you have this potential mismatch between S corporations and partnerships. Both flow through entities, but S corporations having presumably much larger W-2 amounts because of the treatment of salary payments to S corporation shareholders when compared to salary type payments paid to partners in partnerships. So we'll have to watch for that as well. So choice of entity, how's this all going to impact our choice of entity decision? If you look at the 21% C corporation rate, that sounds pretty attractive, and you might, as we talked about, consider going into C Corp status even if you're not in C Corp status now. And when you add to this the ability to deduct state and local taxes, which individuals, trusts, and estates are not going to be able to do, that might make the C Corp rate look even better. But when you take into account the benefit of the pass-through deduction, this 20% deduction that we just talked about, and the 29.6% effective rate that pass-through entities are going to have as a result of it, assuming they're able to fully use that deduction, the pass-through rate still looks better than the corporate rate when you take into account both legs of the double tax. Of course, corporations pay taxes at the corporate level. When they make distributions, the shareholders pay tax at the shareholder level. At the shareholder level, you have a 20% dividends tax or a capital gains tax if you did have a redemption or liquidation and produced a capital gain. We still do have the 3.8% Medicare tax that would apply to both of those income amounts, the dividends and the capital gains in a corporate context. So when you put that together, the rate at the shareholder level is going to be 23.8%. Add that to the 21%. It's not, of course, a direct add because you take into account that the corporate tax paid by the corporation is not going to be subject to the shareholder tax because it's not going to go out to the shareholders. Putting those together, you do have a 39.8% rate, which, of course, is quite a bit higher than the 29.6% rate that is going to apply to the pass-through entities. And as a result of this, we do expect most people in flow-through form to stay in flow-through form. But if you did have a pass-through entity that had businesses that would not be qualified and therefore would be subject to the now 37% individual rate, I do think the case for moving to Subchapter C becomes a little bit more compelling. Whether people will grab a hold of that, we'll have to see. But it's now something that people are going to have to think about, perhaps a little bit more than they're thinking about it for their 2017 and earlier years. It'll be an interesting discussion in some cases. Other things to think about in that same decision, the corporate rate is permanent. It does not have a sunset, unlike the pass-through deduction and the individual rates. But that doesn't mean that the corporate rate can't be changed. And so if you moved into Subchapter C form, you could be stuck there because, of course, moving into a corporation for tax purposes is a whole lot more difficult, a whole lot easier than moving out of a corporation. Sometimes people have referred to Subchapter C as a Venus flytrap, where it's easy to get in, but it's real hard to get out. You've got lots of tax issues that emerge when you're trying to move out of Subchapter C status into flow-through status. You could always move to be an S corporation, but there's issues in doing that. So it's something that people are going to have to think long and hard about before deciding to do. You also have this idea that if you were a Subchapter C corporation, well, how about just retaining all your revenue and not making any dividends? And by doing so, you would avoid the second leg of the double tax. Just pay the 21%, but don't distribute anything and don't pay the taxes at the shareholder level. That's not quite so simple because there's accumulated earnings tax positions that the government can take if you're keeping revenue beyond the reasonable needs of the business inside the C corporation. The government can effectively treat you as if you distributed those amounts and subject the shareholders to a tax. So again, a long and hard decision. I do expect most pass-throughs to stay as pass-throughs, but from time to time there may be a reason to make a move. REITs did especially well in this legislation. REITs, of course, are corporations that can take a deduction for the dividends that they pay to their shareholders. So as a result, they can avoid the two levels of tax and only have one level of tax at the shareholder level. Shareholders had to historically treat dividends from REIT as non-qualified dividends, which means they were subject to the 39.6% ordinary income rate historically, as opposed to the 20% qualified dividend rate. They still do not qualify as qualified dividends, but they're able to take the 20% qualified business income deduction without regard to any W-2 limit. So pretty good outcome for REIT shareholders, a good result. Now REIT dividends are going to be taxed at a lower rate. Interest expense? Yes. Sure. Don't want to cut Carol short at all. Don't want to do that. So just quickly on the remaining topics that we have here, interest expense, there's limitations on the ability to take interest deductions for both corporate and pass-through entities. They're applied at the entity level, and to the extent that the interest deduction would exceed 30% of the taxpayer's adjusted taxable income, it's not going to be deductible. You do have an ability for real estate businesses to elect out of this, but they have to forego shorter depreciation periods and potentially some bonus depreciation in order to get that effect. Bonus depreciation, we've got 100% bonus depreciation that's going to apply for property placed in service, either new or used property, between September 27, 2017 and January 1, 2023. This phase is beginning in 2023 down and sunsets in 2026. Also, Section 179 deductions are increased to $1 million a year and are now going to be indexed for inflation. Like-kind exchanges, they're still available, but just for real estate. Good news for real estate, not good news for everyone else. Query how personal property associated with a real estate project is going to be treated. We'll have to wait for guidance on that. Carried interest, somewhat of a watered-down carried interest provision was passed, nowhere near as far-reaching as we feared. So now if you have a person who holds a applicable partnership interest, if they dispose of it before holding it for 3 years, or if there is a disposition by the partnership of an asset that was not held for 3 years by the partnership, you would have what would have otherwise been a long-term gain to the carried interest holder recharacterized as a short-term capital gain that's going to be subject to ordinary income rates. Big issue here is it applies only to businesses that both retain and return capital, and then also deal with specified assets. What does it mean? What does it mean to go out there and effectively raise capital? Does that mean if I go ahead and grab all the people on this panel and try to set up a real estate deal, and I take a profits interest in the deal, am I subject to this provision? I'd like to think no, but we'll have to see how far that stretches.
Not like it could be a problem.
Sure. Last thing that I'll say, Sam talked about this NOL issue. We don't have carrybacks anymore. We just have carry forwards, which are indefinite, but there is this limitation to 80% of the income. And of course, the open question about whether it's meant to apply to NOLs that are 2018 going forward or all NOLs. With that, Carol, over to you.
I get the clicker?
Yes.
Maybe I can figure out how to use it.
Bottom button.
Button. Okay.
One more. There you go.
Okay. In the compensation and employee benefits provisions, I always like to talk about this because people tend to be interested because these are the one provision that deals not just with the business, but with your personal income. So therefore, we have a lot of questions at this point about how they're going to apply. We have now eliminated the employer deduction for business, entertainment, amusement, or recreation. This actually is going to put a premium on trying to define what you do as being something other than entertainment. We talk about, for example, you have a meeting like this. We may serve you breakfast, but it's not primarily an entertainment meeting, unless you are really entertained by the tax law. So this is one of the things we'll have to look at going forward, because sometimes in the past we've sort of had this overlapping entertainment purposes versus business purposes, and we've now got to figure out which is which. Moving expense reimbursements. The employee tax exclusion is going to be repealed for now and reinstituted in 2025. One of the things about this entire bill on the individual side is that a lot of the provisions are in effect for a few years and then they go away again. So trying to do major tax planning when the law changes all the time is a special challenge. But in many instances, what this is going to mean is that if you are trying to induce somebody to move across the country in order to work for you, you are actually going to have to pay them more, because otherwise, if it costs them $2,000 to move across the country, they don't want to be told, well, you're not really getting $2,000, you're getting $2,000 minus the taxes you have to pay on that $2,000. So businesses are going to have to look at how they can provide incentives for people to move that, maybe are larger than they've had to deal with in the past. Transportation fringe benefits is one of those instances in which, Sam talked about sometimes they didn't quite think things through. what we've got here is, for example, on the parking expense, we, in the past, that if the employer provided a reimbursement for parking expenses, this was not taxable to the employee, but it was deductible by the employer. At this point, the employer loses the deduction for that amount. The employee can still treat that as a non-taxable benefit, but the employer loses the deduction, which in many instances means that the entire plan becomes not particularly tax favored. You know, if the corporation and the employee are paying similar tax rates, it really doesn't help you to have a transportation benefit from a tax standpoint. And therefore, you have to look at whether this makes sense from an employee relations standpoint. And in many instances, it won't, because why would you give a greater benefit to those of your employees who are parking as opposed to those of your employees who are coming by public transit, who are coming by bicycle, who are walking to work, whatever? That as a fairness matter, you may discover that it really just makes sense to raise everybody's compensation by some amount rather than continue to give a special transportation benefit.
Carol mentions the bike riding because she's featured in a Washington Post article about commuting to D.C. on her bike every day.
Yeah. Hey, bike riding is really important.
Hey, Carol, to that, though, also, if you increased everybody's salary, then that would mean more W-2, which might mean a bigger pass-through deduction.
Yes, right? Yeah, absolutely. One of the things that has been misreported in newspaper articles about this is they have said, well, gee, if you have a transportation plan which simply says that employees can elect to put aside part of their own salary for transportation benefits on a pre-tax basis, that this won't affect it because they still get that pre-tax basis. That's not true. Because the problem is that, for example, you've got the employee who's making $1,000. They are putting aside $25 of that money for their parking. What is going to end up happening is that in the past, the employer has been able to deduct the $1,000 regardless of whether it goes into wages or whether it goes into transportation benefits. At this point, the employer is only going to be able to deduct $975 of their compensation because $25 is treated as a transportation benefit that then becomes non-deductible. Now, with the moving expense reimbursements, I talked a little bit about, you sort of have to pay extra to get people to move. With some of these, some other areas in which there have been changes, what employers will likely do is to eliminate their plans. I mean, if you're off in some jurisdiction that where you don't have that great a parking amount, or in which you talked about the fairness issue, you just want to increase everybody's compensation. That works from a federal tax standpoint. It may not work from a state and local law standpoint. In the District of Columbia, for example, you are required to allow people to purchase parking on a pre-tax basis. This law was originally set up because the district said, well, gee, it doesn't cost employers anything to give employees this benefit, and employees get a tax break out of it. So, we're something that doesn't cost anything to business and provides a benefit to employees. Why wouldn't we tell businesses to do this? Well, after the change in federal tax law, it does cost the business something because all of a sudden they lose the deduction on the $25 in my example. However, state and local law has not changed. So you may still be required to provide your employees with this pre-tax benefit, even though it now costs you something. And we've seen instances in which it costs the employer a lot. They've got, all their employees doing this, and they've lost the deduction for it. Okay, employee achievement awards. These have been something of an issue in the past because they have allowed on a tax-free basis particular awards to be made to employees. And the employer gets the deduction, the employee doesn't have to take it into income. Now, simplest case on this is you give somebody a plaque for exceptional service. It is clear that the person is not taxed on that plaque. On the other end of things, what you potentially have a situation in which somebody gets a $500 bonus for wonderful service, and that clearly has been taxable. The issues have come up in the in-between items, and those have ranged from, under the current regulations, for example, giving someone tickets to the football game as an award for service has been treated, any kind of sporting event, has been treated as an acceptable award that then is not taxable to the employee. These regulations date back to the time where admission to football games or theater events cost a whole lot less than they do now. And it's not just that giving these particular items has been an issue. It's also that when people look at whether other types of awards are going to be taxable or not, they've said to themselves, well, gee, we're paying for X. That's about the price of a couple of theater tickets. Therefore, this should also be non-taxable. So while they've got some specific things that they have made taxable, they've also eliminated the ability to just say, well, what we're providing is the cost of a couple of theater tickets. Therefore, it should be treated exactly the same for a tax perspective. They also have specifically continued what was previously in regulations, but now is in the statute, that if you decide to give people some either cash or an equivalent, it is going to be taxable. And what's an equivalent? For example, you get a gift certificate that allows you to buy anything on Amazon. Now, that's not cash exactly, but since most people are buying things on Amazon anyway, it's kind of the equivalent of cash. It's not one specific item you're giving the employee. It's a credit towards any item that the employee wants to buy. So those are now specifically treated as taxable amounts. Meals provided for the convenience of the employer. This one probably has less of an effect than one would think, because there are a lot of places, for example, that provide a cafeteria for employees where they can purchase meals, but the purchase price is lower because the employer is providing space for the cafeteria. That's not affected at all. The only instances in which the meals provided for the convenience of the employer are an issue is in a situation in which the employer is providing free meals because they don't want people to leave the premises. For example, you got a fire station. You don't want the employees all being out to lunch at the point at which there's a fire. And therefore, the employer will often provide free lunch to the firefighters. That all of a sudden becomes a non-deductible amount, assuming this is, private rather than governmental. And this actually is going to affect primarily a lot of institutions that you would think of as, institutions you want to foster. I mean, where you've got a doctor's office, for example, and, people have to be on duty because there could be an emergency, urgent care center. People have to be on duty because there could be an emergency coming in. Those places are going to be affected by this. Qualified plan loans. This deals with your retirement plans, for example, your 401k plan. In the past, one of the issues has been that if you, for example, you have a $50,000 account balance, but $20,000 of it has been loaned to the employee. The employee then terminates employment and wants to take a distribution and have it rolled over into an IRA in order to avoid taxation on it. The problem is that the IRA is not going to continue that loan. It's simply going to take cash that is given to it. So if you have this $50,000 account balance and a $20,000 loan, you have to roll over $50,000, not the $30,000 you're actually getting, in order to avoid taxes. And this has presented a hardship for people because, of course, number one, they needed that loan in the first place, so they probably don't have a lot of spare cash. And number two is it's a very short period. You've got to have moved the money within 60 days, and people may not be able to pull that cash together. So what we've now got is a rule that says, all right, you're going to have a bit longer time to come up with that $20,000 so that you will not face an immediate hardship at that point at which you have your distribution rolled over into an IRA. The new type of tax-preferred equity awards, these are the qualified equity grants. What's the problem that this is supposed to resolve? The problem is that there are various kinds of equity grants in which the taxation applies at that point at which you get employer stock. That works reasonably well for public corporations. You know, if you're getting stock in IBM, say, and you need to pay the tax, you can sell some of the stock to pay the tax. It works not so well in the case of privately held entities because there is a very limited ability to sell your stock. And what you can end up with is a situation in which you have stock that has a particular nominal value. You know, it's supposed to be worth something, but if you can't sell it, you don't have the money with which to pay the tax. So what this is doing is extending the period that basically allows you to defer taxes for up to 5 years after receiving the stock under the option, for example. However, in order to do this, you have to have a broad-based plan. There have got to be grants to at least 80% of the U.S.-based employees. Grants have to be made on similar terms, can't be available to 1% or greater owners or some of your top executives. And also the use of the qualified equity grants limits the company's ability to buy back other outstanding stock. The timing is similar to the Section 83B election. You've got to make this election within 30 days after the settlement. And the effect is similar to the 83B election. You know, you're deferring the tax, but you lock in the ordinary income amount, and then the subsequent appreciation is treated as capital gain.
Carol, we've got just a couple more minutes.
Okay. Excessive compensation. Publicly traded companies are kind of used to this in the sense that they, if they are paying more than $1 million, they've already had to make some adjustments. The one new adjustment is the performance-based compensation exception is lost. The biggest deal on this one has been the effective date, that those plans in effect on November 2 of 2017 are supposed to be grandfathered. However, a lot of those plans have a provision for other tax reasons that the employer can decide not to make not to pay this compensation unless the employee is still there on a particular date, for example, and or just not pay it at all. If there's some discretion to end the plan, question is, does that mean that the plan was not in effect on that date because the employer could revoke the whole thing? And that may depend on state law because some state laws limit the employer's ability to take it back unless there is some strong business reason why they have to. This is also a big deal for nonprofit employers that suddenly have this excise tax, and potentially for certain governmental employers, although which governmental employers are subject to it is something that is extremely vague under the law. We're all worried. We're all wondering about the Alabama football coaches, for example.
Especially Georgia.
Okay. I'm not going to go into this too much. It's all in your materials. I'm sort of running out of time here. But there were a number of extremely onerous provisions that did not make it into the final bill. But these should be looked at in the sense that they may be what Congress looks at the next time they want to raise some revenue. So, now's the time to be thinking about sort of how you would deal with anything that comes up in the next bill, and of course, talk to Sam.
Good. Thank you, Carol. Brian, if you can pass that down. I'm going to run through very briefly some of the miscellaneous changes, and as I'm doing that, ask my panelists to think about the sort of top takeaway in their area that they'd like to share with you. Well, the rate decreases. There's a chart in there showing the difference between what the rates were in 17 and earlier and the breaking points under the new tax act. So of significance is the fact that the highest bracket, that 37%, really kicks in once you reach an income level of $600,000. Kiddie tax, there's a change there for depending on whether it's earned or unearned income. If it's earned income, it's taxed at the single taxpayer rate. If it's unearned income, it's taxed at the trust and estate rate. So unearned income is going to be taxed the same rate such income would be taxed if it were held inside a trust or an estate. The big thing that hit all the news was the state and local tax deductions, the disallowance for that up to the $10,000 limit per year. Sam, when he was talking about the guidance that the service has issued dealing with real property taxes, the service's position, which Mnuchin, I think, has reinforced earlier this week, is that unless the tax was already assessed at the time you made the payment, it's not going to be deductible. So those who ran out to pay their real property taxes at the end of 2017 in Maryland, it's not going to work. The mortgage interest deduction, so that's been capped on indebtedness not to exceed $750,000. If the debt was in place in the middle of December, that's grandfathered, provided that the debt did not exceed the amount of debt that was outstanding at that time. You completely lose the deduction for interest on home equity debt. So you've got a cap now on interest on debt in excess of $750,000, and you no longer get a deduction for interest on home equity debt. The P's limitation phase out, the so-called 3% and 80% rule, which said that once your income exceeded a certain level, your itemized deductions were reduced by 3% of the amount of that excess, not to exceed 80%. Actually, that limit's been phased out, so it's no longer subject to the P's limitation. Future alimony payments are no longer deductible. The payor is no longer permitted to deduct those payments, and the recipient no longer has to include those payments in income. I was trying to think why that was written the way it was. And then
most likely because the payor usually has a higher income and is a higher tax bracket.
And I concluded that very same thing. Sure. Exactly right.
Revenue raiser.
I wonder what that was scored as. I'm trying to think what else there is. The AMT exemption increased to $109,000. A change in the 529 plan area. You are now permitted to use 529 plan balances to pay for tuition for K through 12 schools. That includes both parochial and other private schools. You've lost the itemized deduction for investment expense advice, and as I look around the audience, I see a lot of accountants and tax lawyers and investment advisors. Those fees are no longer deductible. So it makes you wonder, at least in the investment area, if now you're going to try to start to bundle those fees in some cost of disposing of assets. So a load, for example, or a transaction cost of selling stock, that would reduce the amount of income because it would be reduce the amount of your amount received. But if you charge that client a percentage fee based on their assets under management, that investment management fee would no longer be deductible. Kind of reminds me of the unbundling of fiduciary fees. I think there's anything else. And then sort of the last thing I just wanted to point out is that the fact that your standard, you've lost the personal exemption, which was $4,000. The standard deduction has been increased to $24,000. And so the big fear was for those people who are making charitable gifts, smaller charitable gifts are going to be chilled because there's really no real incentive in terms of reducing their taxable income by making that charitable gift if their standard deduction of $24,000 is sufficient. So if I have a choice of make a charitable gift or doing nothing and getting $24,000 standard deduction, I'm going to get the $24,000 standard deduction, and I will lose the incentive to make the charitable gift. Again, a smaller charitable gift. It remains to be seen as to whether or not that really will chill the smaller gifts. As I said at the outset, we wanted to be able to leave you with one takeaway. I asked my co-panelists to come up with one. So I'm going to start with you, Sam, and move down the panel.
My one takeaway. Do not underestimate the political risks that remain with this bill. When you hear permanency, think 3 years, 2018, 2019, and 2020. Generic polling indicates that that there's a momentum towards a Democratic House in 2018. In 2020, there are 21 Republican senators up and 12 Democrats. If we have a Democratic president, be it Bernie Sanders or President Oprah Winfrey, or take your pick, rest assured that their economic policy will include increasing the corporate rate, increasing the taxes on global income, on the BEAT, the base erosion tax, increasing the individual rate back to 39.6, and reducing the estate tax exemption amount from 11.2 or whatever it is.
Yeah, so in light of that, my takeaway is very similar in the sense of flexibility. So if you're in a situation where you're not going to be taxed anyway, go forward, do what you're doing, and focus on income tax planning and basis planning. But if you're in a situation where this could affect you in 3 years, 2 years, 6 years, whatever year it is, we need to build in a lot of flexibility. So this is not a permanent situation where we can just move forward and assume it's all the same. But focus on gifting for those who can do the gifting, use it up, and assume it's going to go away. I think that's my big takeaway.
A similar theme from me, if you're in pass-through entity form, stay in pass-through entity form. Chances are you're going to want to stay. Maybe in some unique circumstances a move might be worth considering, but also echoing the concept that we really don't know if the 21% rate's going to stick around indefinitely. Be very, very careful before moving out of pass-through form.
I'm going to make 2 takeaway points because I deal with it on both the business side and the individual. From a business side, what you need to do right now is to look at your benefit plans and recognize that in the past, a lot of them have been tax-driven. At this point, perhaps it makes sense to relook at them to determine what makes sense from an employee relations, attracting and retaining your employees more than from a tax perspective. From an individual standpoint, the rates are the lowest they've been in years. This may be a good time not to try to defer income. For example, if you're making a contribution to a 401k plan, maybe you want to make it a Roth contribution for which you get no deduction this year, because that means that after the rates go up, the amount that you take out is going to be non-taxable. So you're paying tax this year at a low rate rather than some later year at a higher rate. So those are the big things I think to look out for.
Unless they change the Roth rules, right?
Unless they change the Roth rules, or, yeah, it becomes extremely complicated, or unless deferring compensation puts it into a year where it takes you over $1 million.
And I think the Roth rules have been a target many times when they're looking for revenue raises. So I, too, will take the liberty of recommending 2 takeaways. The first one is you might want to try batching some of your charitable contributions. For example, rather than make them annually equally over a period of years, you may want to make a large amount of charitable contributions this year where you're over the standard deduction. Take the benefit of that standard deduction, contribute them to a donor-advised fund or a private foundation, but typically a donor-advised fund, and then get the deduction on the contribution, but make the distributions in subsequent years. So front-load those or package them in a particular year where you can really get an income tax benefit from that strategy. And the second takeaway is this is a complex area. Please consult with your venerable attorney if you have any questions. Thank you very much for joining us this morning. We have a couple minutes for questions, but we'll also remain here afterwards. Okay. Arnie, did you have a question?
Well, if it's been fully depreciated, you're going to get a different answer. If you've already ran through its term, it's not going to meet the definition of qualified property. So, for example, if you bought it more than 40 years ago and its basis is down to 0, then it doesn't count for that 2.5%. But if you're in the depreciable term, then you still count it based on its cost, its original cost, as opposed to its depreciated basis. So it's original basis versus depreciated basis in determining the 2.5%, which is a good answer.
Good. Other questions? Free legal advice. Yes, Alice.
So you addressed the issue if you're in a pass-through, you're likely to stay there unless you have some special circumstances. What if you are in a C corporation? Would you be thinking about moving the other direction?
Probably.
If there were costs associated with costs that used to be 35% that are now 21%.
Probably. Yes, the question was, if I'm a C corporation now, and I've historically been a C corporation, do I consider moving out of C corporation solution in light of the new law? I would think you'd probably be more incentivized now than you would have been before the law to stay as a C corporation. But one positive change is that if you go from C to S, which you can do typically on a tax-free basis, as opposed to going from C to partnership, which is typically going to be taxable to you. You have a built-in gains period, a 5-year period within which if you sell any assets that were appreciated when you were a C corporation, you still have to pay corporate taxes on those even though you're now an S corporation. If you're in that situation, at least the corporate tax rate is going to be 21%, which as before it would have been 35%. So it's better from that standpoint. But if I'm a C, I'm probably going to look at it and think maybe I must stay a C.
Great. Others? Thank you again for joining us.